If you are a trader who is losing money more than making money, then most likely it's because of leverage. In this video, I will show you how leverage wiped out my account and made me lose more than $37,000. Now, granted, there are many reasons why traders lose money more than make money. But if I want to pick the top 3 reasons why traders fail, then leverage will be in the top 3. Now, don't get me wrong, leverage is an extremely important factor in your trading journey. In fact, it is one of the best reasons to grow your account quickly. But the slight misuse of leverage will wipe your account. About 16 years ago, I bought an indicator set. This happened at the time when I was looking at the best indicator to trade with, because in my head, I thought it's a single indicator, single strategy, that's what makes traders rich. So the 3 indicators basically gave you signals to entry and exit, and the whole set worked together, and I paper trade with the whole set, and of course it was profitable. So then I decided, okay, now it's time to trade. So I wired $35,000 to my existing account, which had about $2,000 in it, with a total of $37,000 and change. Now at the time, the S&P 500 E-mini futures requirement to trade intraday was $500. So I thought, since I had $37,000, I have a big buffer to trade more contracts. And I calculated, well, I can make 4 points a day, that's $200. If I trade 10 contracts, so that's $2,000. So I should be making around $20,000 to $30,000 a month, depending on my win rate, which I'm sure most of you listening to this video are doing the same thing. Now, I started trading and I was making money off and on for a week, and then suddenly I was hit with a big drawdown. And then the next day, another drawdown. So I thought, well, the system works. I traded, I paper trade the system for a while. So I thought, okay, now the percentage are even higher that the system will make money. So in my feeble head, I decided to double the contract. So I went from 10 contracts to 20 contracts. And within 2 days, literally 2 days, I overtraded, wiped out my account. Moral of the story is more leverage will always yield to more losses. It's actually mathematically built in, but it's so hidden that traders don't see it. And they will always welcome more leverage. Of course, the advantages of the brokers, because then you trade more and you wipe out your account and you add more money and so on and so forth. And I will prove this to you with data. So here is a robust strategy that's trading the S&P 500 E-mini futures. The strategy is trading a single contract. So we can see it's a single contract. Starting capital is $25,000. For the past 18 years, we make about $180,000 after slippage and commission. The win rate is very respectable at about 73%. Average trade is about 520, and the drawdown is 32,000. Return to drawdown is 5.4. This is an extremely simple strategy. It's a mean reversion strategy on the S&P 500, long only, no filters. I just wanted to illustrate to you how leverage works. So first, let's start with the historical backtest. This test most likely will not be repeated in the future. That means even though this system is robust, it is profitable, the sequence of the trades most likely will not be repeated in the same way in the future. So we can see here we are making about $180,000. And if I change the sequence, you can see nothing changed. The graph changed, but I'm still making exactly the same amount of money, same trade, same average trade, same everything except for the drawdown. The drawdown will change because the sequence of the trades will determine my drawdown, while my total net profit is determined by the number of trades and the average trade. So I can repeat this. And you see every time I change it, we have a different drawdown, but it's the same net profit. So if I go back to the original, and remember we are starting with $25,000. Now the current margin requirement for the S&P 500 is $15,000. So if I change my starting capital to $20,000, Well, nothing changes because I still have enough money to trade this sequence. But if I go to $18,000, you see now my trading stops here. This is the number of contracts, and you see my trading stopped at about 24 trades. Let's look at the trades. You see, this is my starting equity, $18,000. First trade was profitable, and so this is my equity. So it went 18, 19, 21, and then over at this trade, I lost $3,000, lost 780, profit 1,495, profit, losing trade, and then when I hit this losing trade, my equity falls below $15,000, which means I cannot trade anymore. So therefore, the strategy stopped trading. So lesson one, because we have leverage, we need to take care of this sequence of trades, meaning the sequence of trade will decide if we can trade the strategy or not. Now, how can we find out the leverage in futures and what's the amount of capital needed not to fall into this trap? So first of all, you need to take the price. So this is the price as I'm recording this video, the price of the S&P 500 index. It's 5625. Okay, so 5625. Now, each point in the E-mini futures is $50. So times $50. That means every contract in the S&P 500 E-mini futures is controlling $281,250. But the margin requirement as of today, when I'm recording this video, if you go to any broker, the margin requirement is $15,180. Now, this is not determined by the broker. This is determined by the exchange. And this moves up and down depending on volatility. So as of today, if I divide this number by the margin requirement, then I get my leverage. So my leverage today is 18.5. So every future contract has leverage built in. Of course, that's one of the advantages of trading futures. You don't need to borrow money to trade with leverage. It's already built in and you don't pay any interest for it. Of course, the disadvantage is you need to know how to use it. So let's start here first. Every futures contract has leverage built in. And in this case, we have 18.5 leverage for S&P E-mini. This is like you are depositing money in Forex and they give you 18-1. Okay, so we go back to our strategy. We have leverage here 18-1. Even though the strategy is robust, this part is done. We did our research, we built the strategy, it is robust. How much capital do I need to trade this strategy and not face the probability in the future that I will lose money and cannot trade anymore? So if I do a Monte Carlo testing here, so I'm starting with $25,000, and to trade this strategy by taking into account all the possible equity curves in the future, and I run a 5,000 simulation, this is the result. I have a 76% chance of ending in profit. That means there is 24% chance probability that my account will be wiped out at some point. Even though the strategy is good, this is because of leverage. Now, if I increase my account to 55,000, now my probability goes up to 99.68. So by doubling my capital from 25 to 55, it's more than double, a little bit more than double, I basically deleverage the strategy. So instead of getting 18-1, I'm now getting about 9-1 because I put more money in. So that means my leverage is probably 9-1. So with 9-1, I have 99.6% chance that my strategy will be profitable at the end of whatever number of trades I have, 300 trades or so. And I have less than 1% chance that my strategy will face a wipeout. So that's how you deleverage your strategy. Now, let me show you what usually happens and what I did 16 years ago. Now, to show you what happened to me 16 years ago, I was trading intraday. And this is what's intraday margin today. So it's about 1550. So let's imagine this scenario now. I start with 5500. My initial requirement is 1550. But now I'm going to trade more contract because, I can afford it. Well, I will trade one contract for every $2,000 in my account. That means I'm taking more leverage. So this is what I'm doing. Every $2,000, I will trade a single contract. It's the same strategy, but for every $2,000 in my account, I'll trade one contract. And if I run the simulation now, let's see what we get. I have almost 90% chance of getting wiped out. 90% chance of getting wiped out. And this is how the leverage is working. So you see, I started with 5,500, and for every $2,000, I'm trading one contract. So in this case, I trade two. I made 1,500, so my account now is 7,000, 72, 8, 9, 11, 16, 22. And then at this moment in time, because I'm trading more, because my account grew to 22, and for every 2,000 I trade one contract, that means now I'm trading 11 contracts, and I get, basically this is exactly what happened to me. I traded more contract, and suddenly I was hit with a big loss, but because of my number of contracts, this was amplified. And this is exactly what happened here. Look at this. So 2,400, instead of losing 2,400, because I had 11 contracts, I lost 26,000 plus, and that wiped out my account. Regardless of how many simulations I show you, the end result is always the same. More leverage always yield to being wiped out. It doesn't matter how robust is the strategy. If you like this video, then you will love the next one.